We have to deal at the very end very efficiently with something called inflation. It's in our scope of interest, because why at all we are using this sort of rates? Because generally in economy, inflation happens. In recent years, in many economies, it does not happen. But because there's too much capital and so on and so on. But inflation is the rate of increase in the general level of prices for goods and services. It is recorded as an annual percent movement. An inflation rate can be measured by consumer price index, retail price index, or GDP deflator, any procedure that shows the rise of prices. Generally, most likely it will be the first two or even the first consumer price index. And so it means an item which costs you £1 today will cost you £1.5 in a year at an inflation rate of 5%. Yes, true. This would happen. If inflation is 5%, something that costs £1 today will cost £1.05 in the year time. So as inflation rises, every pound you own buys a smaller percentage of each good or service, right? Because it's getting more expensive. So in this example here, this year £1 bought you everything, but in next year £1 will buy you probably like 95% of something. So you might ask, if this inflation is small, relatively small, 2% per year, and an item costs you £1 today, and it will cost £1.02 next year, does it matter in 1 year? Or does it matter in 10 years? Does it matter? It's very important to know. Does it matter? We know the calculations of the value future, present, we know already. So let's make a very nice calculation. At just 2 percentage points of inflation per annum, this item that we have in mind, that costs now £1, in 1 year will cost £1.02. But if we compound these small, tiny 2%, then we end up in only 10 years with the figure of 1.219. So in 10 years perspective, this item is more expensive of 22%. So you could see this compounding values for future in this case are really very difficult, because difficult and dangerous, because it shows that even a small inflation, very small, 2%, if it rolls for a long time, it gives quite substantial rises of prices. Still, let's imagine what would happen if it's 5 for 10 years. Brilliant. Now, these examples of inflations are obviously very striking, and now we have a graph that shows this consumer price index of Venezuela and United Kingdom. And the United Kingdom is the scale on the right, the blue one, and Venezuela is the scale of this red on the left, and the graph is yellow, unfortunately. So, let's see. Even in UK, prices went substantially, very substantially, between 95 and 2016. Look, it started on the level, this is not exactly, but the level, because it gives us the starting point somewhere at 2009 or something like this. But look, it started with the level of about 80 and now it's 120 in only 20 years. So the rise is quite substantial. However, there are countries like Venezuela when this inflation was dramatic. So how could you reasonably make any estimation of any project with any normal interest rate when suddenly you have hyperinflation like this? Therefore, this sort of hyperinflation, which is very high inflation, is so dangerous for the economy because suddenly the prices there, are many reasons why, went up. And then about the inflation, we have a shocking example. I want to show you this example. This is Zimbabwe. Where is Zimbabwe? Anybody knows? Yes, in the heart of Africa, in the south, sort of north of South Africa, the country. So it was already very high in March 2007. The inflation was at just enormous number of 2,200% per year. But then inflation rose, and in February 2008, the inflation went up to a shocking 165,000% per year. And then in June 2008, the inflation went to 2,200,000%. You know, the changes were dramatic from day to day, from hour to hour even. The amount of money was incredible and the value of money went down like a stone. So in July 2008, the central bank, issued a note of 100 trillions, yes, is this one? Or billions? Billions. And this was the price of one loaf of bread at the time. And still inflation was rising impossibly. And year to year, per annum, in July 2008, inflation was at 231 million %. Incredible. So, in January 2009, the bank issued banknotes, just banknotes of the wealth of the value of 10 trillion, 20 trillion, 50 trillion, and 100 trillion Zimbabwean dollars. Incredible. So this shows how the hyperinflation might go up incredibly beyond any comparison. It's very, very dangerous for the economy. How could you plan anything? How could you save anything? I mean, saving has no sense at all. So let's have this continuing shocking example, because living in the conditions of hyperinflation are extremely harsh. I once lived in a condition of almost 600% per year, so it was impossible to plan anything. But these figures in thousands or millions are, for me, absolutely beyond any imagination. So we have the worker. Let's have this example. Inflation in February is 2,200% per year, and the worker is paid on this 1st of February equivalent of 150 euro. And with this speed of inflation, what this money would be worth in a sense of euro on 1st of March? Anybody would do the calculation? As far as I remember, I did the calculation. So his pay being worth in 1st of February 150 euro, on 1st of March it was worth mere 7 euro or 6 point something. So how a worker would like to be paid in Zimbabwe? The answer is in nature, like he would prefer to be paid in bread or something that he could sell. Why inflation happens? This is a question. So basically, government issues too much money. And then there is a huge demand pressure on the market that pushes the prices up. And as well, and this is by far very important, external influence caused by natural or social events, some kind of revolutions, civil wars, etc. Well, it's very late. I hope you enjoyed this part.